Hi, my name is Anu Buzruk. I work as Senior Academic Assistant at the Learning Commons Department of College of DuPage, mainly helping with accounting courses. In my earlier video, we looked into the inventory costing initial concepts. Now let's go into a little depth of the concepts. That means how to assign the costs to your ending inventory and to your cost of goods sold, because these two line items go directly in your final statements. Like balance sheet reflects the ending inventory value and the income statement reflects the cost of goods sold. So let's look into this concept. Now, how to assign these costs? It depends on that particular company's decision or assumption as to whether they want to assume that the costs flow as per the inflow of the physical inventory, or whether the costs flow in reverse direction of the physical inventory. Now, one important thing to be remembered here is physical flow of the inventory items and the cost flow of the inventory items need not be in the same direction. So let's look into these different methods. So first is FIFO. FIFO means first in, first out. So what is our assumption here is whatever is the flow of the items, the same flow, same direction is considered in the cost flow also. Means, let's look into the basic equation that I talked about in the earlier video. Beginning inventory plus purchases is whatever is available for sale minus ending inventory is cost of goods sold. Now, in whichever flow your inventory is coming in the warehouse, the same flow is being followed as far as the costing of the inventory is concerned. That is what is meant by first in, first out. Whereas second method is LIFO, or last in, first out. So here it's the exact reverse. Whatever is the physical flow of the inventory in the warehouse, in the reverse direction we do the cost flow assumption. And then the another method is weighted average method, where the costing is done on the basis of average of whatever is the total cost available in the warehouse. Now, all these concepts will be easier to understand if we go for a practical number example. So let's go for a very small example. So suppose as on August 1st, okay, let me write it here. So these are my dates. Then this is my purchase quantity. Then this is my purchase rate. And this is my purchase amount. Then this is my sale quantity. And based on that, this is my ending inventory quantity. So let me explain it again. Date, purchase quantity, purchase rate, purchase amount, sale quantity, and ending inventory quantity. Now suppose on August 1st, we already had 10 units of a particular inventory item, and we had purchased them at $10 per unit. So my inventory cost is $100. Now, suppose on August 5th, I purchased another, say, 12 items of the same inventory item. Let's suppose that it's the increasing trend of price in the market, and so I could purchase it only at $12 and no more at $10. So the total amount of my purchase is $144, and hence my total ending inventory changed from 10 to 22. Then on August 15th, say, I am going to sell 10 units out of these. Okay. Now here we are talking about periodic inventory system. So in this particular video, I'm explaining periodic inventory system and not perpetual inventory system. We talked about this in the earlier video. Periodic inventory system means you take the inventory, you account for the inventory only periodically and not at the every day of purchase and sale. Okay, so now suppose August 15th itself is the end of our accounting period, and so we have 10 items that we sold, then 22 items that we had purchased. So 22 minus 10, in this way we have 12 units in our ending inventory. Now our goal is to value or to find out the cost of these sold units as well as ending inventory units. Now this value depends on which method we follow or which is our assumption. Let's go for the first assumption. The first assumption is first in, first out, means whatever is the flow of my inventory in the warehouse, the same flow I am following as far as the costing of the inventory is concerned. That means if I say that I have 12 items remaining in my warehouse, that means they are from the latest purchase, because my cost flow is first in, first out. Whatever came in first has gone out first. So when I sold 10 units, those 10 units are from my beginning inventory. And so that's why whatever is remaining in my warehouse is from my latest purchases. So in this way, my inventory as per first in, first out will be, let's again follow this equation so it's little easier to follow. Beginning inventory plus purchases is what is available for sale minus ending inventory is what is cost of goods sold. So now let's talk about all the three methods parallelly so that you will understand it better. These are our three methods. Now let's talk about these costs. What is happening with the beginning inventory? Irrespective of the assumption, beginning inventory is going to remain the same. My beginning inventory is 10 times 10, that is $100. So $100 is the value of my inventory in my warehouse, and I purchased only 144 worth. So as you can see, irrespective of the method of costing, your available inventory is going to remain the same. Pardon me for not writing it in perfectly horizontal way. So now let's talk about ending inventory. First in, first out. As I said, First item has gone out first. So whatever is remaining in my warehouse is my latest purchase, and in this way 12 times 12, 144 is the value of my ending inventory if I am assuming that my method is first in first out. But if it is last in first out, that means whatever came in last has gone out first. That means when I am selling these 10 units, I am selling them from my latest purchase. So my ending inventory of 12 units consists of my oldest purchase. So these 12 units consist of 10 items which I had purchased at 10 and 2 items which I had purchased at 12. So in this way, my ending inventory by last in first out is my older stock. So 100 plus 24, 124 is the value of my inventory as per last in first out. And as far as weighted average is concerned, all we are going to do is look at the average cost of whatever we have available. So what we have available is 244 worth inventory, and we had purchased total 10 plus 12, that is 22 items. So 244 divided by 22 is 11 point something, I believe. So 11.03 or something like that. And in this way 133 will be my inventory cost. What did I do? My inventory is 12, so 12 times 11.03 is 133. So in this way my ending inventory by all the three methods is different, and so obviously my cost of goods sold is also different. 200 is the worth of whatever I sold, whereas here 120 is the worth of whatever I sold, and here 111 is the worth of whatever I sold. Now what does this mean? As I mentioned in the beginning, where does this value go? In your balance sheet, you will be showing the ending inventory, right? And in your income statement, you will be reflecting the cost of goods sold. So what is the effect of cost of goods sold? Sales minus cost of goods sold is your gross profit, correct? Now let's look at the consequence of these, or the final effect of all these three methods. So as you can see here, as per last in first out, my inventory is least compared to the other assumptions, and my cost of goods sold is highest compared to the other two assumptions. And here I had made a silly mistake of the math. 2 minus 1, I had written it 2, and now I have changed it to 1. So my cost of goods sold as per first in first out assumption is not $200, it is $100. Now let's see how this reflects in our financial statements. So if I follow last in first out in increasing prices condition of the market, my cost of goods sold is going to be highest. When the cost is high, the profit is going to be low. Higher the cost, lesser the profit. Lesser the profit, lesser the tax implications of the business. So the businessman or the businesswoman will be spending less money on taxes to be paid to the government. And at the same time, when you look at the ending inventory is also least. So whatever is the inventory that is reflecting in the balance sheet is at a at a lower side. So which assumption to follow depends on that particular company's decision. If the company is more interested in saving taxes, they will be going for last in, first out and reflect high cost of goods sold and consequently lesser profit and lesser taxes. But if a company is more interested in showing high value of their inventory in the balance sheet, then they will be going for first in, first out assumption, where the ending inventory value reflected in the balance sheet will be 144 as against 124. So higher the inventory in the balance sheet, better is the picture for the shareholders or the investors of the company. They will have more confidence in the company and they will tend to invest in your company. So it all depends on the owner of the company as to which assumption to follow, whether to follow the assumption which follows the physical inventory flow or to follow the assumption which is in reverse or going in the opposite direction of the physical flow of the inventory. Depending on that, the different methods will be used. And as you can see, the weighted average method is something in between the two. So my $111 cost of goods sold is in between $100 and $120. And my $133 value of my inventory is in between 144 and 124. So these are the three different methods or assumptions followed by a company while costing the inventory and deciding as to what cost should be reflected in the final financial statements of the company.